Leslie Brew, and I've spent over 30 years in commercial real estate, specializing in CAM reconciliations, lease structures, and escalations. My goal is to make complicated lease clauses simple so you can make confident decisions. Today we're answering a big question: which lease type is best? Welcome to Which Lease Type is Best. In this video, we'll compare different commercial lease types, highlight their pros and cons, and help you figure out which one could be the best fit for your needs. Leases aren't just paperwork. They directly impact costs, risk, and predictability. Choosing the wrong structure can cost thousands over time. Understanding the strengths and weaknesses of each type makes it easier to protect your bottom line. In a full-service lease, the landlord covers nearly all operating expenses, while the tenant pays a single lump sum rent. These leases are common in office buildings. They offer simplicity and predictability, but rents are usually higher. Many also include CPI escalations to protect the landlord from inflation. Triple net leases, or NNN, shift most of the responsibility to the tenant, covering property taxes, insurance, and maintenance. The base rent looks lower, but total costs often rise once expenses are factored in. These are common in retail and industrial properties, and they give tenants transparency and control. A modified gross lease is a hybrid. The landlord pays some expenses, while others are split or passed on to the tenants. The exact structure is negotiable, which makes it flexible, but also variable from one building to the next. It's popular in multi-tenant office and flex properties. A base year lease locks in operating expenses for the first year. In later years, tenants cover any increases above that base. It offers stability up front, but costs rise over time. This setup works best for long-term tenants in relatively stable markets. Expense stops set a limit. The landlord pays up to a certain level of expenses, and the tenant pays anything above that amount. This gives tenant a predictable baseline, while landlords protect themselves from rising costs. It's a fair balance, especially in multi-tenant buildings. Gross-up clauses adjust operating expenses as if the building were fully occupied. This prevents tenants from unfairly paying more when a building has vacancies. Gross-ups protect landlords' income while keeping cost sharing fair for tenants. Expense caps limit how much certain operating costs can rise each year. For example, a cap may restrict increases to 5% annually. Tenants gain predictability and protection from sudden spikes, while landlords take on more risk if costs rise faster. When you look at all the lease types side by side, the differences are clear. Full service offers simplicity but at a premium. Triple net is transparent but pushes costs to tenants. Modified gross and base year balance the risks. Expense stops, gross ups, and caps create fairness and predictability. Some leases lean tenant friendly, like expense caps and full service. Others lean landlord friendly, like triple net and expense stops. Understanding who benefits most from each structure helps both sides negotiate smarter. The best lease depends on three main factors: the property type, the tenant's priorities, and the landlord's strategy. Office tenants may prefer full service. Industrial tenants usually see triple net, and landlords choose based on risk, tolerance, and market competition. There isn't one universal best lease. The right lease is the one that matches your financial goals, property type, and risk appetite. The key is knowing what matters most to you and negotiating from that perspective. Thanks for watching Which Lease Type is Best. For more videos on CAM reconciliations, lease clauses, and commercial real estate insights, visit my channel, Commercial Escalations Made Easy. Don't forget to like, subscribe, and share your questions in the comments. I'd be glad to help.